boutique hotel investing is one of the newest trends in real estate, and it comes with some amazing tax benefits. So in this video, I'm going to talk about what is boutique hotel investing, what are the tax benefits, and how this would work. So let's go ahead and get started. Boutique hotel is basically taking a property with multiple rooms and renting it out as a hotel. Unlike major hotel chains like B.R.R.T and Hilton, boutique hotels are usually run by smaller investors or mom and pop investors. A lot of thought leaders in the real estate space are pivoting to the boutique hotel space. People like Brittany Arneson, Bethany LaFlamme, Rich Summers, and Tony and Sarah Robinson, just to name a few. As you probably already know, there are a lot more regulations that are coming out in the short-term rental space, but people love the cash flow of the short-term rentals. So operating properties like a boutique hotel allows investors to overcome that short-term rental restriction. Another great reason to invest in boutique hotels is because it is a lot more scalable. So you buy a multi-family, and if we can rent it out as a boutique hotel, you might be able to have on-site manager operate it all locally within one property, versus if you bought 10 or 12 short-term rentals that are spread out throughout the town or throughout multiple states. Sometimes they are a little bit more difficult to scale compared to a boutique hotel. Also, we're seeing a lot of people going through retirement. Traditionally, small motels and hotels are operated by mom and pops. And so you have the boutique hotel space where a lot of people are retiring. And if you happen to be someone who's really great at real estate and you can turn that property around, then you might be able to create some truly forced appreciation and generate better cash flow by just making a few tweaks to how things are operating. Cody Sanchez is someone who talks a lot about buying boring businesses.
So the way that I think is interesting to do boring businesses is we talk about the B.R.R.T method. So boring businesses that are recession resistant, where you can raise prices and add technology.
For me, I feel like the boutique hotel space is a really great example of that. You have people who've operated these motels in the past, and now you can come in, buy the property, and operate it at peak efficiency. Not only does it create a great return in cash flow, but also forced appreciation too. Let's talk about the tax side of it. As a boutique hotel investor, it is very similar to short-term rentals. Why do we call it a loophole? Well, because if you invest in a boutique hotel, you don't have to be a real estate professional to be able to use those strategically created tax losses against your W-2 and other income. That's right, it's treated very similar to the short-term rental loophole. And this works really well for people who still have a full-time W-2 job. Comparatively speaking, if you're someone who invests in long-term rental properties, if your income is over $150,000, usually rental losses are passive losses, which means it does not offset taxes on your W-2 income unless if you or a spouse is a real estate professional. A couple different ways to qualify for real estate professional, but one of the most difficult hurdles for people to overcome is that you have to spend more time in real estate than your jobs. And so for investors who work full-time or married couples who both work full-time with income above $150,000, usually you cannot use the losses against W-2 income. And the reason we call this boutique hotel a tax loophole is because we don't care how many hours you're working at your full-time job. You can potentially use the rental losses from your boutique hotel against W-2 income as long as you meet one of the material participation hours requirements. For boutique hotel operators, usually you'll have a whole crew and staff to operate the property if you're not doing it full time. Then one of the best ways to meet material participation is for you and a spouse, if you have one, to earn at least 500 hours on your boutique hotels. It could be you acquiring the property, setting it up, dealing with your management team. Maybe from time to time you deal with guest issues or marketing. As long as you're involved in the day-to-day operations and you meet the material participation hours on the property, then you can strategically create tax losses through things like cost segregation, accelerated depreciation, bonus depreciation, and then be able to use that loss against your W-2 income or against income from other business you may have, even though they're outside of real estate. For boutique hotel investors, if you're someone who owns a couple different properties, you can actually combine your hours together across different properties to meet that 500-hour requirement. In the boutique hotel space, usually we buy the property, and if you're doing it correctly, maybe you're creating forced appreciation. When you're creating forced appreciation, something really important to do is make sure that you are keeping track of all the things that you're doing. If you're buying new furniture and fixtures and just bringing the property up to date, most of those are eligible for tax benefits either in the form of a tax write-off or through depreciation as well. What if you're not involved in boutique hotels, but you would like to be a passive investor? Let's say somebody else has a deal in the boutique hotel space and you would just like to be a passive investor in it where you invest your money and everybody else from the syndication team does all of the work. In those scenarios, you could still get the benefits of depreciation and cost segregation as well. All of those net losses can offset taxes from the other passive income that you generate. And the passive income could be from other businesses that you invest in or other long-term rentals as well. So as a passive investor in the syndication of a boutique hotel, if you're not able to meet material participation with respect to your own properties, then you still get the benefits, but it just doesn't offset W-2 income versus if you're more hands-on with respect to your own deals. But nonetheless, passive losses are still great because we can use them to help offset taxes from all the other passive income that we're generating. If you like this video, please hit the like button and subscribe so you can get all the latest tax strategies.